right, good afternoon, everyone. I'm Jerry D'Ambrosio. Welcome to today's webinar, 3 techniques to help you capture trades of a lifetime. Hope everybody's doing well, as good as you can do, I guess, with this market over the last couple of days. However, we are well off of the session lows, so hopefully we see a nice strong rally here at the end of the day, heading into a 3-day weekend. Markets are closed on Monday here in the U.S. So I just want to do a quick sound check just to make sure everybody can hear me okay. Those of you in GoToMeeting, if you guys don't mind, just use the chat box, the question box, just to say, yes, I can hear you. There we go. Michael says, sounds great. Good. Anybody else? If Michael can hear me, pretty sure everybody can. There we go. Douglas says loud and clear. Well, awesome. All right. Great to see a lot of friendly, familiar names of people who come to our coaching sessions. So it's great to have you guys back here today. My promise to you is that by learning what I'll show you today, you'll see how you can use technical indicators to help anticipate what is likely to happen in the future. And notice, I'm not claiming here that technical indicator predicts anything. I'm not here to predict anything. It's not about predictions. It's about using these indicators to anticipate changes in trend, changes in oversold or overbought situations, changes in supply and demand balance. So we're kind of identifying these situations to give us an idea of a potential trade. And again, we try to pinpoint entries and exits, and that's really what technical indicators allow us to do. I've got a lot to cover today. As I show you the techniques, if there's a tool that I use to help me, I'll show you that tool. And at the end, I'll show you a way to get the tool if you want it. Now, I really would like you guys to stick with me to the end. I'm not going to take too much of your time. We're going to be together for about an hour. But if you do stick with me to the end, I will share with you a copy of today's slides. Okay, just somebody remind me at the end, right around 2:50 or so, say, hey, Jerry, don't forget the slides, and I'll put them in the handout section of your GoToMeeting control panel. Okay? Now, the people I've worked with, I've been with VectorVest now 14 years. They let me know over the years some of the problems that they have when it comes to finding trades and using technical analysis for trading. Remember, this is going to be a swing trading methodology. This is not investment strategies. All right, so I want to be very upfront there. We're talking about trading, swing trading. You hold on to a position for a few days, maybe a few weeks. We're not talking about your retirement account or any type of an investment approach. Okay, so the trouble that they have is, number one, they feel like it's a crapshoot. With the market being so up and down, volatility recently has just really started to pick up. You feel like trading stocks in general is a crapshoot. They don't have the knowledge, or they didn't have the knowledge. They felt like they just didn't know everything when it comes to trading. Again, there's that word again, trading. So they avoid it. They stick with what they know. Fundamental valuation. Buy and hold-ish, as much as you can. You always want to use stops and you want to pay attention to the market, but it's more of a longer-term investment. And that's what they kind of went back to after realizing, okay, I don't know as much as I need to know about trading. There's just too many indicators. There are all these funky names, so they just say forget it. Plus, when they did do it, they found themselves looking at chart after chart after chart after chart after chart. I've spoken to people who go through hundreds of graphs in a day just to find a handful of trades. You can imagine, you keep doing that for too long, you're going to get really frustrated. You're going to give up. Again, you're going to kind of throw in the towel when it comes to trading. And by the way, shorter term trading, taking gains quickly, reinvesting your gains into the next position, you can really supercharge your overall profits. Okay, a couple of people guys are saying, is the audio on? Can everybody hear me okay? Those folks might not have their speakers on. There's nothing I can do there. Can you just tell me, let me know? Okay, Ahmad says okay. There we go. Thanks, Ray. I appreciate that. Okay, so what you want to do There we go. Josephine Manesh says I can hear you. Good. You want to put probability on your side. You don't want it to be a crapshoot anymore. You want to stack the deck in your favor. Look, you're not going to know everything about every technical indicator in the book. There are too many of them to learn initially. You want to know what you're doing, and you'll know exactly what you need to know to be successful. Plus, you want to be able to find your trades quickly instead of spending hours upon hours and hours looking at different charts and trying to identify setups. And you can spend all day doing that. We want to be able to do that quicker. Now, the thing that I discovered is that there are 3 areas that traders need to focus on to be successful. Okay? Excuse me. Number 1 is when. Okay, so we're a stock selection indicator that is ideally suited for that type of market environment. And I'll explain exactly what that means in a moment. And then finally, how am I going to find my trades? All right, so the first, the top of that triangle is what is the market doing? Got to recognize what the market's doing first. Then which indicator, which technical indicator is ideally suited for that market? I'm going to show you how to use the indicator. And then finally, how are we going to find our trades? Okay? The first thing you need to understand is when to use the indicators. There are 3 main types of market situations that we need to talk about. Okay? First, the market can trend. We've been in a nice trending market now for a while. Last couple of days, changed things quite a bit, but we've been in a nice uptrending market for a while. Really since, beginning of April. Okay, I know the bottom was in March, but then, when you talk about a trending market, you don't count the bottom. You count when the market began to trend. It doesn't begin to trend off of the bottom. It explodes off of the bottom. That's what we call the blast off phase, but that's not the beginning necessarily of a trending market. What we need to see is higher highs and higher lows off of that bottom. Then we can recognize a trending market, and I'll show you guys really what a trending market looks like. Then the market can no longer trend, right? It can move sideways. We call that a trader's market. Investors hate it. They don't like traders markets. They don't like channeling markets because they're not really making much money. If the market's moving sideways, the average stock is doing the same thing. Okay? But traders love it because they play it up and down, back and forth as it develops. And then there are situations like we saw in March of this year, like we saw in December of 08, okay, when the market hits extremely oversold situations. So recognize that the market doesn't just trend. We'd all love it to, but it doesn't do that. It moves sideways, it becomes extremely volatile, it gets crushed so badly where it then hits an extremely oversold level, or you can look at an extremely overbought level as well. So here's what a trending market looks like. Here's what a trending market looks like. Now this is February of 2017 to January of 2018. Don't worry about the time frame, okay? It's the environment, the market environment that we want to understand and pay attention to. This is a trending market, right? How do I know that? Well, the market's hitting higher highs and higher lows on a monthly basis. And what our jobs are as traders is in an uptrending market to be bullish only. What do I mean by that? I mean, we're not looking to short stocks in an uptrending market. We're looking to buy at opportune situations. Those situations for traders are the dips. Okay, so as a trader, we look to buy the dips. New high, pullback, higher low, a signal of some sort, whether it's a bearish candlestick formation or a moving average retracement that lets us know that it's okay to start buying stocks again. New high, pullback, trend line touch, moving average touch, retracement off of that trend line, retracement off of that moving average tells us that we can buy again. Pullback, new high, pullback, same thing. So what we're looking to do is we're looking to buy the dips. I know that's easier said than done, but study how to do it, understand what to look for, and it becomes a little easier over time. And I said we don't want to be bearish. Why? Meaning we don't want to short stocks in an uptrending market. Well, we're in an uptrending market. What does that mean? longer uptrends for the most part and shorter pullbacks. It's an uptrend, right? So you're going to have longer uptrends and for the most part shorter pullbacks. So we don't want to get into a situation where we short the retracement back to an intermediate term moving average. We want to be defensive at each subsequent higher high, meaning take profits, tighten stops, protect gains. Okay? Now, 2017 is over. We're into 2018. So here we're looking at January of 18 to about August of 18. Okay? And the market, as you can see, is no longer trending. It's not trending upward and it's not trending downward. It's moving sideways. We're no longer hitting, it's called a trader's market. Why? Because, well, I'll tell you in a second. We're no longer hitting higher highs, but we're not hitting lower lows either. Okay, we're moving sideways. Essentially what the market's doing is bouncing back and forth between support and resistance. Could be a narrow channel, could be a wide channel, but we're not in a trending market anymore because new highs were not established, nor are we in a downtrending market because new lows were not established. I said traders love it because what they love to do is play the market up and down as it bounces off of support and resistance. Okay? Traders are bullish at support, they're bearish at resistance. Then we get into a situation where the market hits an extremely oversold situation. This is December of 2018. This is, okay, so I'm sorry. A lot of you folks are not VectorVest subscribers, so you're probably wondering, okay, what's the candlestick? What is that? Is that the S&P? Is that the Dow? It's called the VectorVest Composite. The VectorVest Composite, it's VectorVest Broad Market Index. It's really the foundation of our entire market analysis system. It tracks almost 8,000 stocks. So you can look at it like it's the S&P or the Dow or the NASDAQ or the Russell. However, it combines them all. It's not just looking at 500 stocks or 30 stocks. It's looking at the average movement of 8,000 stocks. We feel it's a better representation of the overall market because it tracks a lot of stocks. Okay, so what happened here at the end of 2018 is the market got crushed. It was in a downtrend. Okay, and then what happened was the market hit an extremely oversold situation. In VectorVest, an extremely oversold situation is identified by the MTI, stands for Market Timing Indicator, being below 0.60 and the buy to sell ratio being below 0.20. But we give a buy, a sell, and a hold rating for every stock in our database. We look at the relationship between buys to sells. It's a very important indicator in our program. Buy to sell ratio below 0.20. I'll just tell you, there are 5 sell ratings to every 1 buy. Very oversold market, very bearish environment. MTI identifies the underlying trend. Above 1, the underlying trend is up. Below 1, the underlying trend is down. It's on a 0 to 2 scale. And when we see it below 0.60, that's really low. That's telling us that the market is extremely oversold. And we're looking for an explosive rally to occur. Now, we don't buy stocks just because those indicators get to those levels. We wait for a rally. Okay, that rally happened the day after Christmas. You can see this big unfilled green candle here. That pattern, by the way, is called a one white soldier. Nice bullish reversal pattern, follow through, and that was the bottom. So that was an extremely oversold market situation. Those are the 3 types of market situations that you're likely to see. Okay, trending, we know what to look for now for a trending market: higher highs and higher lows. If you don't see that, you're likely you're going to see a trader's market, a market that's moving sideways. If you don't see higher highs or higher lows anymore, you're in a trader's market. Then it doesn't happen often, but when that MTI gets to 0.6 and the buy to sell ratio gets to 0.2, again, it might happen once a year, maybe. Sometimes it happens more, sometimes it doesn't even happen in a year. It didn't happen in 2017. Happened, maybe twice in 18, once in 19, and we know it's happened in 2020, just a few months ago, 5 or so. Okay, so next, if you're in a trending market, the ideal indicator that we're going to use is called the MACD. MACD stands for Moving Average Convergence Divergence. Think about it this way. So you're in a trending market, right? Do you know anything about moving averages? If you do, you know that they are trend analysis indicators. Well, it makes sense to use a trend-based stock selection indicator in an overall trending market. Okay? In a trader's market, when the market is moving sideways, and we saw what that really looks like, right? Bouncing up and down, back and forth between support and resistance. Well, let's use support and resistance to help us find stocks. For example, if you see that the market is retracing from support, maybe for the second time, let's go find stocks that are also retracing from their own support levels. Okay, if the market's retracing from resistance, let's find stocks to short that are retracing from their own resistance levels. Okay, and then finally, the stochastics oscillator. I love this indicator. I use this indicator a lot. I pair it with bullish and bearish candlestick reversal patterns for a lot of my own trading, some of my own trading. I use some other techniques as well. But when the market hits an extremely oversold situation, Sherry is asking, as of last 2 days, we are in an extreme market. What's the current MTI and buy to sell ratio? 2 days is not going to cause the MTI to go below 0.6 or the buy to sell ratio to go below 0.2 after such a strong run. I'll tell you, the buy to sell ratio is at 0.81 and the MTI is at 1.17. So not at those levels yet. You know, just 2 days ago, the buy to sell ratio was at 1.73. In 2 days, it's not going to go from 1.73 to 0.20. It doesn't work that way. And the MTI 2 days ago was at 1.51. It's not going to go below 0.6 in 2 days. You might, you look at the market, man, it's gotten crushed over the last 2 days. But, according to our kind of method of looking at things, it's not technically in an oversold position yet using those two indicators. Now, yeah, it's in an oversold position over the last couple of days, but not using those two indicators. They're more kind of a longer perspective extreme oversold market, if that makes sense. Okay. All right. Here's the MACD. Really quick. MACD is a trend indicator. I got the price of the stock at the top, MACD at the bottom. Very simple way to use the MACD. When you see the histogram bars, that's these yellow bars, go above 0, that's bullish. When they go below 0, that's bearish. Okay, you got a horizontal line here at 0. When the histogram bars are above 0, it's bullish. Below 0, it's bearish. Okay, so here, again, don't worry about the time frame. It's the technique that's the most important. MACD histogram bars, you can see, go from below 0 to above 0. Change in trend. Change in trend. That's bullish, we buy. Okay. MACD goes from below 0 to above 0. Change in trend. You can see we're in a downtrend here. You can see that the MACD was negative during this time period, right? You're saying, okay, well, why didn't we buy right here? You got to change. You got to presumably a change in trend right here. Well, look at the MACD. It didn't give you a signal. It did not give you a signal to enter back in during this little rally here. Wasn't strong enough to cause the MACD to turn bullish, but it was here. Change in trend. And you can see that leads to a nice profitable gain. How about here? New high, pullback, MACD histogram negative, and I'll talk about the negative crossovers as well, but the MACD histogram bar is negative. They turn positive, change in trend. Not every trade is going to be a winning trade. Here, as of the hard right edge, as of October 5th of 17, you're probably thinking, well, this is it. Nice big up day. I got a new high. The stock pulled back. Histogram bars were negative. They went positive. This is it. The new leg, I'm getting in, and it's going to continue to move higher. Well, it doesn't. It moves sideways for a little bit. I'll talk about the negative crossover, but not every trade is going to be a winner. Okay? Here, and another opportunity here. So look, and I know you got to look at this and say, boy, we are weeks off of the bottom there, or the higher swing low, right? Because we're now back in a nice uptrend, pullback, higher low. We're a couple of weeks. The MACD is a trend indicator. You need a meaningful change in trend for the indicator to turn bullish again. And this was a significant enough pullback that it caused the MACD to go really far into negative territory. So just logically, it's going to take a little longer to turn back into negative territory. Okay? Okay. Another opportunity here. So this was the pullback from before. We got in right in this area here. New high, another pullback, another higher low. And now this trade probably would have been either a loser or a small gain, because what you're going to do is you are going to use the negative crossovers, the negative histogram crossovers from above zero to below zero to exit your trade. Okay? In an uptrending environment, in an uptrending market, try to identify this type of stock. It's an uptrending stock. Bullish MACD crossovers in an uptrending stock will yield you more winning trades than losing trades. Okay? What happens though, again, here's some more bullish crossovers. What happens is the stock no longer trends. And you had so much success using the MACD in the previous uptrending market that you continue to use the MACD moving forward no matter what the stock behavior is. Okay? We are no longer in an uptrend. The uptrend was broken right around here, July of 2018. We saw higher highs, but what happened? Pullback, rally, failed to make a new high, pullback. Now we're in a downtrend. Okay? Watch what happens if you continue to use the MACD to go long in a downtrend. You fail. You fail here. You fail there again. You're thinking, I'm going to catch the bottom, aren't I? Right? I'm going to catch the bottom. I'm going to use the MACD. If it goes bullish, I'm going to catch the bottom. Okay? And sometimes you will. But you've lost a couple of times in a row, digging yourself into a hole, and it's going to take that much more of a rally, and if you do get lucky enough to catch the bottom, you're just kind of digging yourself too much out of a hole. We don't want to do that. It's not about hoping that we catch the bottom. It's about consistency in our approach. Okay? Next, let's talk about support and resistance. Support and resistance, one second. It's a very popular trading technique, all right? One of the great things about the VectorVest tool is it has a way to automatically draw the support and resistance lines on the chart for you. Let's take a look at what I'm talking about. Before we get too deep, what is support and resistance? Basically, a support level is a point where stock prices have stopped going down and they begin to go back up. Now that typically happens multiple times. It's where demand is deemed strong enough to push the price higher, to support it from falling any further. Resistance is a point where the stock's price has stopped going up and it begins to come back down. Again, typically it happens multiple times. It's where supply is deemed strong enough to push the price lower, to resist it from rising any further. And support and resistance is the ultimate crowd mentality indicator. I want you guys to think of it in terms of this, okay? You buy a stock, you watch it go up. You watch it go up. You don't sell it. Why don't you sell it? Because you think it's going to continue to go up. Then what happens? It comes crashing down pretty hard, right? And you stayed in, you weathered the storm, right? But you say to yourself, man, starting to pick up again a little bit here. What do you say to yourself? You say, all right, if it ever gets back up there again, I'll sell it this time, I will. Then what happens? Eventually it gets back up to that level. You and everybody else who bought it somewhere back here the first time and didn't sell it before the crash or during the crash, now what do? You sell it. And what does that do? It puts tremendous pressure on the stock's price. and it begins to fall. So how do you use support and resistance in your trading? All right, so number one, let's talk about the buying opportunities. There are two. There are two buying opportunities using support and resistance. Number one, price retracing from support. Not price reaching support, retracing from support. Price retracing from support, retracing from support. That's bullish, okay? And that's a buying opportunity. Buying opportunity number two is when price breaks out through resistance. Remember, we already said that there was built-in selling pressure around that resistance level based on the crowd mentality. If the stock's price is able to overcome that selling pressure and bust through that resistance level, preferably on higher volume, that's bullish as well. That's another buying opportunity. Second, you can also use support and resistance to indicate when to sell an existing position or to initiate a short position. So bearish situation number one is if you see price hitting resistance and coming back down. Hitting resistance and coming back down. That's bearish. If you're long a trade, if you bought off of a support retracement and you see price retracing from resistance, that's bearish. That's an opportunity to take your gain off the table and move on. You can also flip it and short the stock if you wanted to, or if you saw another stock that retraced from resistance, you can short that as well. Bearish situation number two, we don't see this on the chart here, but if ever you're in a long position and price breaks down through that support zone, that's bearish. You should consider taking the trade off the table. On the other end of it, if you're not long the trade, you want to take the position short, you can do that. Just make sure price is breaking down through that support level. Typically, it will continue to fall until at least the next support level. Okay? Before I get into stochastics, let me recap. You recognize what the market's doing first. I can't stress that enough. The market's trending. If it's hitting higher highs and higher lows, let's use the MACD. I mean, there are a ton of other indicators that you can use, but one of the things I said earlier is new traders who are just kind of starting out trading this way, they overwhelm themselves with so many different indicators and they wind up getting frustrated and giving up. Let's not do that here. Let's just pick one indicator for a trending market. Let's use the MACD. It's a very effective indicator that identifies meaningful changes in trend. If you no longer identify that the market's trending, if it's not hitting higher highs anymore, if it's not hitting lower lows, but it's moving sideways, it's bouncing back and forth between the market's own support and resistance levels, let's use support and resistance. Okay? Finally, market hits an extremely oversold situation, and within VectorVest, we recognize that situation when the MTI is below 0.6, buy to sell ratio below 0.2. Okay, we're going to use the stochastics oscillator. Another great indicator. As with other oscillators, it helps pinpoint overbought and oversold conditions. Don't let all the squiggly lines confuse you. It's not confusing. Now you can Google stochastics if you want to know the calculation. If you want to know the calculation of MACD, you can Google it. I'm not interested in the calculation or even teaching it to you. I want to teach you how to use the indicator. Okay? So on the lower end of stochastics, by the way, it's scaled between 0 and 100. Below 20 is oversold. Above 80 is overbought. I'm just going to focus on the oversold situations today and the buying opportunities. Excuse me. Would you agree that when the stochastics oscillator went below 20, we were somewhere near a buying point? Right? We were somewhere near a buying point. Now, just because stochastics goes below 20, that doesn't mean you buy the stock. The trigger is when stochastics goes above 20. That's your entry. And you'll see here how close to the bottom or how close to the low the indicator gets you in. Here we're only a couple of days off of that low. Here we're, basically right at it, right at the bottom. Here we're 3 days off of the bottom. Now, by the way, remember earlier I said that there will be situations and times where you mix and match indicators and market situations. Well, this is one of them because you can use stochastics in an uptrending market. You can use it in an uptrending stock. The only indicator I would never mix and match is the MACD. Only use the MACD in an uptrending in a trending market. It's going to fail you if you use it in a sideways market. Okay? But here you're only 3 days off of the low. Now the next time the stochastics oscillator went below 20 was 7 months later. And here you're only 3 days off of that low. Here you're only a couple of days as well. Okay? So let's mix and match. Let's mix and match stochastics and support and resistance. I'm going to show you guys a little bit about how kind of to manage, how to manage the trades. Okay, so here, February of 2018, we got a stochastics crossing from below from below 20 to above 20. That's a buying opportunity. A couple of days before that, so you're in an uptrend still, right? You're in an uptrend. A couple of days before that, you had a bullish harami. That's a bullish candlestick reversal pattern. Follow through the next day. You got a nice pivot point there that you're working off of. Okay. If I take that trade, I'm big into candlestick analysis. The thing that jumps out to me on this chart is this area here. Do you guys see those long upper wicks? Long upper wicks and closes near the lows of the sessions in an uptrend, that concerns me. That's not bullish. That's not a strengthening uptrend. It's a weakening uptrend. Okay? So what happened after those long upper wicks? What happened after those shooting stars? That's what they're called. That's a bearish candlestick formation. The stock pulled back. Crashed pretty hard enough where stochastics went from below 20 to above 20, we get in. That area is an area where I'm going to look to take gains off the table. I'm always looking to take action at the most recent swing high. Take half off, let the rest run. So what happens? Price reaches that level, fails to make a new high, right? So you hope that it does, right? What type of stock would you be in if price continued to rise and made a new high? You'd be in a trending stock, right? Now that the stock's price failed to make a new high and pulls back, what is this level considered? It's considered resistance now, right? What did we say about what to do with a long position if price retraces from resistance? We said that's bearish. You should consider selling it. Okay? Let's say you do. You're out the whole time. Stochastics was really overbought, by the way, as well. Okay, above 80. Stochastics falls now down below 20, crosses above 20. The stock stopped falling at essentially the same level that it stopped falling back here. Right? So it stopped going down. Stochastics went above 20. You can see a little bit of a rally here, right? A little bit of a retracement off of that support level. And you entered in, and I wouldn't have blamed you, and I would have as well. You entered in the next day, only to see the stock, you see that big red candle, only to see the stock crash the following day. And you're like, oh man, here we go again. Buy a stock and it goes down the next day, or it goes down right away. And maybe in the past you panic sold, right? But let's look at things. Let's look at things a little bit. Let's look at the chart a little bit more carefully. You entered in the trade off of a support retracement, off of a pop, off of a retracement, off of essentially the same level where the stock rallied last time. So you're saying, okay, I know the stock's down the next day, but it hasn't fallen below that support level. And in the future, you're going to get yourself in a situation like this, and you're going to think back and say, remember what Jerry said. Jerry said, okay, if I'm in a trade and price breaks down through that a support level, maybe I entered the trade long off of a support level, but I'm not in the trade but a couple of days, and price breaks down through it. It's going to happen. Consider selling it. Well, price didn't break down through the support level, did it? It stopped right at it. It retraced from it, and you're thinking, all right, I paid attention. I'm in the clear now. Stock's going to continue to move higher, but it doesn't. You basically get back to break even, but then the stock falls again, right? It falls again, and you're saying, all right, I'm not going to panic this time. I know that this support level here is going to protect me, okay? Stock price stops at that level again. That's a hammer, by the way. That's called a bullish hammer. That's a bullish candlestick reversal pattern. Right at support, follow through the next day. You can almost bet that the stock is going to continue to move after that, and it did. And you weathered two storms and paid very close attention to the chart, didn't panic sell, didn't sell just because you're in the trade, a couple weeks and you're not making much money. You're following the chart. You're paying attention to the chart, and you're um, managing the trade the way you're supposed to. Now, stock rises. Now you're profitable. Remember this resistance level, right? Well, it doesn't just go away, it stays there. So the stock reaches that resistance level again and then retraces from it. Okay? And there's your opportunity to take the trade off. Stock price didn't fall all the way down back towards support again. Doesn't always do that, right? But it fell enough where stochastics went from below 20 to above 20, giving us another opportunity to enter the trade. Look, resistance is still there. We still have to pay attention to that resistance level, even though we didn't enter, in this case, off of support. We still got to pay attention to that resistance level. Okay? Price runs, stops at resistance. You see that big red candle? You're out of the trade. Okay? I know very well, right, what happened afterwards. And I could have sat here and said, "Oh, I'm staying in." I would have stayed in the entire time. There's no way I would have. You're not following the rules if you do. You got a resistance touch, a resistance retracement, you're out of the trade. All right, so the stock rallies the next couple of days. What does it do? It breaks out through that resistance level. When price breaks up and out through resistance, that resistance level becomes support. A lot of times what you'll see is price, after it breaks resistance, retest that level, that what now is support. And what did it do? Retested support, stopped right at it, retraced from it, retested it again, right? That retest also had stochastics go to below 20. So here's a situation where you not only have a support retracement, but you also have stochastics going from below 20 to above 20. And the stock ran after that. Okay, now we're back to an uptrending stock. Now we're back to an uptrending stock, and the stock pulls back. Stochastics goes from below 20 to above 20, and it rallies for a day, and you enter, which is what you were supposed to do. You're looking at higher lows here, but then the stock pulls back again, right, a couple of days after you get in. That higher low that you entered off of, because you're in a trending market, is your exit, is your initial stop. Okay? Knowing very well, look, if you get out at a small loss, you're always able to get back in. And the stock broke down far enough where stochastics actually went back below 20, crossed above 20, there's your re-entry. Now you're in a situation where you're in a channeling market again. You're in a channeling market. You're not in a trending market anymore. I'm not hitting higher highs, not hitting lower lows either. Okay? So you might get whipsawed around a little bit. But here now we have a pretty significant support level. Okay? Really significant support level. One touch, two touches. Here's your third touch. Your third failure to move below that price zone. Your retracement, stochastics going from below 20 to above 20. You're in the trade a couple days, stock crashes on you, but it stops at support. You don't panic sell just because the stock goes down for the last couple of days, and then you're able to stay in the trade a little longer. Okay? By the way, market's rallying nicely, guys, by the way. I don't know if you guys are paying attention to the market. Dow's only off 100, NASDAQ 170, S&P 26, so well off of the lows. One of the first things I said at the start of today's webinar, I said it would be nice to get a nice strong rally heading into the close, into a 3-day weekend. So far, so good. I don't want to get ahead of myself, but we're seeing a nice strong rally here. All right, third, how am I going to find my trades? you know now what to look for, right? You know to look for either a trending market, a channeling market, or an extremely oversold market situation. Once you do, you have three indicators to use. Okay, you have three indicators to use. How then, after you recognize number one and number two, the when and the what, how are you going to find your trades? There are three ways to do it in our view. The first one is one by one. This is where you look at the charts. All right, chart after chart after chart after chart. I don't mind looking at charts, all right, but I like to run a search first. I like to run a scan that'll filter through, the junk, and so to speak, or filter through stocks that don't meet the criteria that I'm looking for. For example, if I'm looking for a MACD bullish crossover, I want to run a scan that's going to find me all bullish MACD crossovers. Then I'll look at the charts to pick out some of my favorites. Then finally, there's even a faster way, and that's by getting automatic alerts. Okay? Now, the one by one method. For example, you're looking at the S&P 500 or any list of stocks that you like to trade. And I said this already. Let's say the market's trending. Okay? The market's trending. You want to find MACD bullish crossovers. You pull up a list of stocks. And I'm not going to do this now because it just takes too much time. You put MACD at the bottom of the chart, and you go through the charts. All right, as of the hard right edge, is the MACD first crossing bullish, meaning is the histogram first crossing from below zero to above zero? If it's not, you move to the next stock. I'm not looking for a MACD crossover that happened a week ago. All right, I'm looking for an initial first MACD crossover. And you go through the charts, and you can imagine how long that would take. Sometimes you may not find any. All right, you may not find any. Now, the easier way is to use a scan, to use a search. Within the VectorVest program, within our real-time program, we have a tool called ProTrader. It's a technical analysis scanning tool. It scans for things like moving average crossovers, MACD crossovers, both bullish and bearish, stochastics crossovers, and support and resistance, all four that we talked about. Remember, so there's two bullish situations, retracing support, breaking resistance, two bearish situations, breaking support and retracing from resistance. Our ProTrader tool within the real-time program will find all four of those, along with RSI, EMAs, DPO, ADX, Bollinger Bands, envelopes, ATR. You can scan for a lot of things, okay? A lot of technical indicators, okay? Finally, there's a tool called the Watchdog, and it's another tool within the real-time program. You don't have to be in front of your computer. All you have to do is set it up once. Okay, you set it up once. Again, let's say you're in a trending market. You want to set up a watchdog. It's an alerting system, a real-time alerting system. You want to set up a watchdog to say, okay, I want to look at all stocks in the S&P 500 that had a bullish MACD crossover. I like to look for stocks that are above $5, average volume greater than 250,000 shares. You can adjust those filters as well. And during the day, you don't have to run a search. So let me go back. In the ProTrader tool, you actually have to run a scan. You have to sit there and you have to click a couple buttons, no big deal, but you have to click a few buttons to run the scan. With the Watchdog, you set it up once and that's it. Okay? You set it up once and it will alert you. It will either send you a text message or an email or both when a stock, for in this example, in the S&P 500 meets the MACD crossover. Okay? All right, I'm going to take a few guesses as to why you guys showed up today. Number one, you feel like you're missing out on the current market. Now, the last 2 days notwithstanding, the market's been in a beautiful trend for quite some time. I hope you weren't missing out on it, but maybe you weren't getting the gains that you were hoping for. You weren't outperforming the market. So the trading plan that you were using, it wasn't performing like you wanted it to. You also showed up today because you want a better, faster way to find trades. Maybe you're someone that struggles finding trades because number one, you don't know what to look for. Number two, it just takes you too much time. So what we learned today is to match the market to your indicator. You got to recognize what the market's doing. It's really, really important to do that. You know, you've heard before, if the market goes up, right? 80% of stocks are going up. If the market's going down, 80% of stocks are going down. If the market's moving sideways, 80% of stocks are moving sideways. Our philosophy is we want to be on the right side of the market. We want to make sure that we're trading or investing in tune with what the overall market's doing. So you recognize what the market's doing. You now know what ideal indicator is best suited for that market. And you also have a much quicker and easier way to find trading opportunities. And that's by using the Pro Trader tool within real time, you know, any scanning tool or any alerting system. Okay. Now the big lesson, technical analysis can help anticipate, there's that word again, anticipate, not predict, anticipate future direction, and you can find some great trading opportunities, especially if you use the power of speed. So you might be asking, good stuff, Manesh, I really appreciate that. Saying you're doing a great job. You're saying, okay, I want to get started with this approach. How can I get started using technical analysis? The choice you have is you can do it the fast way or the slow way. The slow way would be to take what I taught you today and apply the one-by-one method to it. It's possible. You can do it. It's the slow way. The fast way would be to use tools that filter through all the other stocks to find stocks that meet the criteria that you're looking for. So let me just kind of talk about what the VectorVest real-time program has. You can do it by the one-by-one method. Remember, we can look at fundamental and technical charting. You can look at stochastics, support and resistance, the MACD. Within the tool, within ProTrader, you can scan very quickly and easily to find stocks that meet the criteria that you're looking for depending on what the market's doing. And then there's the automatic alerting system, okay, where one of the tools that we have is called a watchdog. I showed you what that tool does. It scans the database of stocks for you so you don't have to click a few buttons. Another tool that we have is called the Genius, where it's a real-time portfolio management tool. The VectorVest real-time program includes fundamental and technical charting, market timing signals for clear entries, those pro trader searches, which again are the technical scans, the watchdog, which gives you instant alerts, again, another tool called the Genius, which is an automated portfolio manager, automated, hands-off, and it will give you alerts as well. We also have pre-built trading systems and, of course, real-time streaming data. Now, normally we would sell this whole package, and we do sell this whole package, for $137 per month. What I want to do, though, is I want to offer it to you guys for $9.95 for 30 days. You could try it out for 30 days for $9.95 if you're not currently a VectorVest subscriber. $9.95 for 30 days, and it includes everything that I talked about today. If you are a VectorVest subscriber, but you don't have real time, let's say you have our intraday version, which is a 15-minute delayed streaming data, or you have our end of day platform, or maybe you just have our mobile app, okay? You can also take out this trial for $9.95 for 30 days. Now, what I want to also do is for everybody that takes out the trial, new subscriber or not, I'm going to give you guys this stock buying checklist. This is great for those of you who like to be more hands-on. You know, you want to keep track of, all right, I bought this stock on this day. I bought it because of this. I'm going to sell it because of this. So you're keeping track of, it's basically a trading log, but it's more of a checklist to make sure that you're following all the rules that we discussed today. By the way, it's a 30-day money-back guarantee. Not that you'll need it, but at the end of the 30 days, if you call us up and say, you know what, I want to cancel the real-time program. Thank you, but I want my $9.95 back. We'll give you the $9.95 back. Okay. Question that's coming in. Michael says, I do have the Canadian stock intraday. Will this work? Absolutely, Michael. Now, do you want the real-time Canadian program? If so, you can choose the trial for $9.95 for the Canadian version. Just to let you know that because of real-time exchange fees, the exchange fee for the Canadian market is a little bit more than the US market, but you don't have to worry about that during your trial. That kind of kicks in after the trial's over and you become a subscriber. Okay, but yes, you can. This is for the US or Canadian. You will choose which database you want. Question is, what will be the subscription cost after the trial? Good question. Either $137 per month or let's see, $12.95. Now this is U.S. dollars, and for the U.S. market, $12.95 plus 96. So it's either $137 per month or $1,391 for the entire year. And $137 per month. Come on, clear. $137 per month times 12 is $1,644. So you save quite a bit of money if you were to go with the annual subscription. Okay, so what I want you to do, I'm sorry, Ray, I'm pretty sure you did this already. Yep, Ray, what Ray did, by the way, I want to thank Ray. He's in the background. He's been answering your questions. In the chat box, guys, he typed in the address that you see at the bottom of the screen. So Manesh is saying, it appears I have a login, but I'm not a member. How do I sign up? Go to that website that you see at the bottom, www.vectorvest.com/capture trades. Ray put it in the chat box. Everybody should see it, right? Everybody should see that address that you see on the screen. You should also see it in the chat box as well. And we put it in there so you can click on it. You can just simply click on it. Okay? All right, guys, I'm going to stick around for a few more minutes. Oh, nobody reminded me, and I remembered all by myself. I'm going to now put the handouts, the slides that I use. I'm going to put that in the handout section of your GoToMeeting control panel. And I've done that, and it should be in there. Should be in there now. You should see it's a PDF. It'll say 3 techniques. Okay, it'll say 3 techniques. All right, guys, any other questions before I wrap up? By the way, my email address is Jerry D. Write this down, Jerry D, Jerry, D as in David, at VectorVest.com. Once you sign up for the trial, if you are a new VectorVest subscriber, you will get free coaching, free initial coaching from one of our product consultants, okay? We have a ton of videos within the software. After you do all your initial kind of homework, if you have any questions about the real-time program, feel free to shoot me an email. Again, it's jerryd@vectorvest.com. But we do have free product support. The product support number is 888-658-7638. And the number, if you just go to vectorvest.com, the number is right at the top of the screen. Okay, so I'm just at vectorvest.com. If you ever need our support number, it's free, it's toll-free. And if you ever have any questions, you need any help, you can always give our support department a call. Okay. All right, guys, I want to thank you for being here, taking some time out of your Friday. Well, happy Friday, everybody. Nice 3-day weekend ahead of us. Craig says, I don't see the PDF link. It's in the handout section of your GoToMeeting control panel. Thank you, Michael. I appreciate that. In the handout section of your GoToMeeting control panel. If you don't see it or can't access it, email me and I will send it to you. jerryd@vectorvest.com. All right. Have a great weekend, everybody. It's Labor Day weekend, so enjoy yourselves, stay safe, and we'll see everybody again soon. Take care, folks.